So hello everyone, and thank you again for joining us for our quarterly webinar. My name is Pauline Hickey, and I'm a Senior Marketing Associate here at New Frontier. And I'm very pleased to be joined today by members of our investment and research committees, including research analysts Joy Zhang, John McCrary, as well as our Director of Research, Dr. David Esch, and our CIO, Robert Michaud. Welcome everyone. So for today's presentation, Robert is going to kick things off with insights into our institutional process. Joy will then review last quarter's performance. John will share notes from our market perspectives, and David will round things out with a few research updates. We'll conclude with a few notes from marketing, and as always, time for Q&A. Before we begin, please note that your lines are muted for the duration of today's call. So please submit any questions you have using the chat feature of GoToWebinar. And with that, I will pass things along to Robert.
All right. Well, thank you, Pauline. Thanks everybody for coming here today. And I was, like everyone else, had a lot of time to think over the last year or so. And one of the themes of interesting things that have happened is the rise of retail investing over 2020. And that really came to some kind of a climax this last quarter with Robinhood and Reddit and GameStop. And so thinking about retail investing made me want to contrast it with what we do. And in particular, with Robinhood, for instance, one of their main themes, main selling points and mission statements is the democratization of asset management, and the way it is framed is that Robinhood is going to let regular investors compete with hedge funds and the biggest Wall Street institutions. Unfortunately, it doesn't work out that way, and all the research has said that the more you get into apps like Robinhood, the more you gamify asset management and investing and get people to trade actively, trade quickly on little bits of information and pile into popular topics, the more they lose. And I think the news might be out that in every quarter pretty much, but particularly last quarter, when the markets have gone up, Robinhood users have lost out. So anyway, enough about Robinhood and retail. Let's talk about the right answer, which is the institutional investment framework. And let me just give sort of an overview of what the institutional investment framework is all about. It's this sophisticated, conservative framework that's meant to protect and maximize investment value for the largest institutions. It's historically been very labor intensive, required a lot of highly trained financial professionals for each and every account. And it starts with the investment policy statement, where they do a lot of analysis, almost soul searching at the institutional level to figure out why is this institution investing? What's their goal? What's the reason for investing? Because you always need to say, what's your investment objective before you can have any hope of figuring out what's the right way to invest and what's the right things to invest in. So think about the investment objective. Are you thinking about long-term? Are you worried about inflation? Are you worried about income? Obviously, do things like taxes matter? And just in a simple sense, what's your risk tolerance? Do you want to be an aggressive investor or a conservative investor? Once you've come up with that, then you think about the suitable asset classes for that type of investment objective. Should you have things like real estate in it? Should you have a lot of growth stocks in it? A lot of bonds, whatever. And then the next step is asset allocation. And asset allocation is saying, okay, well, now we want to be smart and take all these different suitable asset classes, combine them in the best way to maximize our likelihood of meeting our investment objectives. And then as in the institutional framework, they generally think of, once they've done asset allocation, what you're actually investing in as a whole separate step. And I'd like to briefly at the end say why that's maybe not so efficient. But that's a labor-intensive process where they interview managers for the best-in-class, hopefully, funds. and that's where also security selection is going to happen inside the funds. So that covers the whole spectrum of investing from the institutional perspective. So where do we go? And one of the most influential and most cited studies in institutional asset management is this Brinson study, which is often referenced as the importance of asset allocation. And really what it's saying is that stock-bond ratio determines an overwhelming share of the risk in your portfolio, so you definitely have to think about that. That was published in the Financial Analyst Journal, but it could have been published in the Journal of course, we knew that. A somewhat more sophisticated study is the Hensel study, which, when thinking about what are the sources of return and what does ultimately drive success of meeting your investment goal, it comes up to the more sensible conclusion of actually everything's important. It's important to do asset allocation well, it's important to have the right type of securities, it's important to make good decisions. And so that's where we come from. That's our type of institutional asset management. The everything is important. You can't ignore any detail of the investment process when you're trying to maximize investor welfare. So the most fundamental thing you're going to try to do is what Markowitz suggested everyone should do, which is try to maximize return, minimize risk for whatever your investment objective is, right? If you're not doing that, then you're being inefficient and you're either taking more risk than you need to, which is meaning that you might not meet your objective, or you're giving up return, which means that you could have done better than what you'd end up doing. So obviously, everyone will want to do something like this, want to optimize a portfolio. The problem is the future risk and return parameters are highly unknown and unknowable, right? If there's this efficient markets hypothesis, and of course we don't think that markets are perfectly efficient, but they're efficient enough so that no one is ever going to know for sure the future. If anyone ever knew for sure that interest rates were going to go up, that Apple was going to be the dominant technology company or whatever, then that already would have happened. It already would have been priced into the market. So when you're doing asset allocation, when you're trying to optimize anything, you have to be worried about the noise that's coming from uncertainty, because noise can outweigh the signal. And it's even worse when you're doing security selection. What has happened? This is just our research into how to optimize under all of this uncertainty, and just showing you how bad the problem is when you try to optimize, and if any little thing is wrong or estimated with error, then you can end up with a very wrong solution. So this is some of our original research on why uncertainty is harmful and just how bad can it be. So many people have come up with different asset allocation approaches, these are optimized asset allocation approaches, because the alternative is you just do it by hand and just do what feels right, or come up with something kind of like an equally weighted portfolio or whatever. And I love talking about all of these things because there's interesting ideas behind them. But the problem is that none of them, until our Michaud optimization came along, could accurately build out a optimized solution for any investment objective that took uncertainty into account. And so that's what we're really experts at, is building optimized portfolios for specific investment objectives, taking all the information that we have into account. And this is just a lovely animation that David made that I don't show enough. And this is showing the process of uncertainty getting resolved in real time. David is a far better artist than I am, but what you're seeing is a well-diversified portfolio getting constructed by thinking about what we do is thousands of different scenarios. This is just showing you the first 50, all the ways that information could work out one way or another, and just you need to build an efficient frontier. You need to build portfolios taking into account the many different ways that the future could unfold that are different from the single thing you expect. So this is our solution. So that's what's special about us. This is the very condensed version of it. And now I just want to say how it fits back into our investment process. So getting specifically into New Frontier's ETF portfolios. So it's not just optimization, we have to do everything else. So to fit it into a ETF portfolio, take the institutional asset management process and make it work for individual investors, we start with ETFs. And so again, we're thinking about why are we interested in any one of these ETFs? Because we are trying to invest in the most reliable sources of economic growth and return to investors over time, and effective asset classes that we understand how they work that can diversify risk. So we're generally thinking about, is it exposed to a risk premium that will provide return over time, or is it some sort of low correlation or diversifying asset that's going to allow us to better manage the risk of the portfolios? Then what we need to do is come up with a way of thinking about estimating the risk and the return trade-off of all of these asset classes. What is their over time expected return? What's their volatility? And how do they, importantly, how do they relate to all of the other asset classes that we want to work with? Then we use that beautiful graphic to come up, it's not the graphic, it's obviously optimization, but to come up with an optimized portfolio that is going to do the best job of maximizing return, minimizing risk, building a well-diversified portfolio for this investment objective that we are looking to make. So then once we have our optimized portfolio for a different investment objective, then we have to make sure that it is still optimal. And so we have a rebalance test that looks at our portfolio every single day to make sure that the combination of new information that has arrived and the total risk picture for the whole portfolio, all of the different ETFs together with price movements and all of the other changes and updates to the investment process are saying that this is still the best portfolio for the investor today. So over the 2020, we rebalanced our portfolios quite a few times. But so typically we're rebalancing a portfolio closer to once a year. In 2020, it was more like once a quarter because information was changing quite so quickly. So we always want to have a very forward-looking, but also a very current understanding of what the risk and return relationships are. And the other thing to keep in mind is that we're always thinking about not just one ETF in the portfolio, but how the whole portfolio fits together to maximize the likelihood of meeting an investment objective. So whether this is a total return optimization for the sort of standard core qualified accounts that we're thinking about, and they're just really tailored, trying to think about building a total return solution for a conservative or an aggressive investor, whether they're tax optimized, including municipal bond funds, including thinking about how risk and return change for a taxable investor as opposed to a non-taxable investor, and also thinking about if your objective is sustainable income. These are very different types of portfolios that are all based on the same principles and investment process, but really just for different investment objectives. So to wrap it all up and say what's different and how we can work together, I do think that this is the true democratization of asset management does involve an advisor to really understand the client's investment objectives, and a reliable core solution, something that is going to be able to build a sophisticated, optimized portfolio with a professional asset manager who's only thinking about the fiduciary practice of, is every decision we make, is every ETF that we've chosen, is the amount of work that we do to look at, risk manage, and think about the total risk and return of the portfolio. Are all of those decisions made in the interests of the end investor and to maximize their likelihood of meeting their investment goals? If you combine those two things together, then you really have democratized asset management in an effective way. So What we do is we have a focus on the total portfolio's risk management. We're always thinking about how everything fits together. We are global experts in portfolio theory, and so this is why New Frontier is able to provide as good a solution as many of the other global firms out there. We've been able to have a great track record over the last 16 years. We're a pioneer. We're really the first people to institute the institutional investment process using ETFs and make them available to advisors on platforms. And the way we do this is that we try to focus on what's reliable, what's knowable, capture long-term economic growth, but also pay attention to the future is unknown, sure, but there are certain directions that it has moved. There are certain new information that does make you give you sort of actionable information to adapt to short-term changes in the market and say that the relationships of the past are not exactly the same as the relationships currently and going forward, and having an adaptive process that is forward-looking is always trying to be long-term optimal, but also make sure that we are making correct decisions based on current economic conditions. So, and put those all together in a core strategic portfolio. So that is hopefully a different type of presentation than I do when I talk about the process. And but that'll give Joy a chance to show you how the performance works for our portfolios. So thank you.
Thank you, Robert, for the investment overview. Now let's take a look at performance. We always like to start the performance with a review of New Frontier indices, 6 global and 6 US indices, ranging from 2080 to all equity, because they are constructed in exactly the same way as our core investment strategies, and therefore describe the performance of strategies in real time. Indices returns are provided by S&P Dow Jones. So 2 charts in front of us are showing the performance of New Frontier indices along with the blended benchmarks in Q1 and over the past year. So 2021 started with multiple good news. We have greater than expected stimulus package and massive vaccine rollout, which has pushed US stocks higher during the first quarter. Yields rallied as expectations of economic growth increased along with inflation expectations. As we can see from here, all New Frontier global and US indices reached all-time highs during the first quarter, as aggressive indices did better than conservative ones, and US indices outperformed global ones. While relative performance against the benchmark were mixed for the quarter, all indices beat their benchmarks on a one-year basis, ranging from 2 to 10% across the board. It's worth mentioning here that with US stocks continue outperforming international stocks for multiple quarters, our global indices here still beat the US blended benchmarks over a one-year period. Both global and US 60/40 indices with the most balanced exposure to different asset classes was up 1.6% and 2.9% for this quarter, respectively. While traditional hedges like gold and long treasuries were among the top contributors in 2020, they did not help this quarter, which in part explain the underperformance compared to the benchmark. The strongest relative performance came from US equity index, which was up 7% this quarter, outperforming the S&P 500 by 1% in Q1 and almost 10% over the past year. And to get a better picture of the growth of our indices starting from the beginning of 2020 to March 2021, we have the plot of global and US equity indices as well as 60/40 indices in front of us. It is now over a year since the downturn we have experienced in March, and the global equity index, indicated by light yellow here, was up 83% since then, 21% since its pre-pandemic high, and returned 23% in total during this time period. 60/40 indices, both global and US, on the other hand, were less volatile compared with all equity indices. Global and US 60/40 have returned 16% and 18% respectively since January 2020. Now we have reviewed New Frontier indices. Now let's move on to New Frontier strategies. What we have here in the chart is our net of fee performance for global core portfolios during this quarter and over 1 year period, along with their benchmarks. Now I think it's very easy to distinguish between 1 year and Q1 performance. As we have mentioned, Q1 was a good time for investing in risky assets rather than assets that hedge risks. Consequently, aggressive global core portfolios outperformed the benchmarks, while conservative and balanced portfolios underperformed this quarter. Since it's just over a year since last March, it's not too surprising to see double-digit returns for 1 year, ranging from 11% to 58%. This is how much we have recovered from the bottom, and this is great for investors who have stayed investing with us. With that being said, one cannot optimistically expect this wonderful 1 year performance to continue in the future. So it's more realistic to step back and look at extended period of time from January 2020 to March 2021, which includes the market downturn. We have seen a V-shaped curve for our indices earlier, and this chart shows the global core portfolios rebounded above the pre-pandemic levels with annualized returns ranging from 5.7% to almost 18%. And the outperformance against the benchmarks were up to 2% during this time period. And for global core, I want to add here that we rebalanced the portfolios in February, and of which the major thing was locking gains from growth stocks and risk management to reduce concentration from risky assets while bringing portfolios back to their risk target. Without rebalancing, an existing investor who is investing with us in 60/40, for example, would have a portfolio that drifted away from the target to roughly 65% equity allocation at the end of Q1. And you may wonder, a portfolio with more concentration in equities has posted strong returns in the past few quarters. But these returns are not without high risks, and not all investors can tolerate these significant risks inherent within equities. Our aggressive profiles are roughly 1.5 times more risky than our balanced portfolios, and 3.5 times more risky than conservative portfolios, as measured by annualized historical standard deviations over the long term. The drifting portfolio by nature is more risky than an optimal portfolio, and without proper risk control for some time, you will expose clients to more risk than desired. So rebalancing, the purpose of rebalancing is really about risk control, not for maximized returns. We want to make sure that portfolio's risk level always align consistently with investors' risk targets. And next is our tax-sensitive. New fund tax-sensitive portfolios are managed with the same investment process with the global core, but with considerations into after-tax returns. So as expected, they performed largely in line with the global core portfolios in Q1, but did relatively better thanks to the allocation to municipal bonds. Compared to other bond segments, US municipal bonds held up really well in the first quarter during the rate rally, supported by a stimulus package. As reflected in the chart, our aggressive tax-sensitive portfolios outperformed the benchmark by 14 to 16 basis points for the quarter, while other risk profiles slightly underperformed. On a 1 year basis, all risk profiles outpaced the benchmark by 1 to 3%. Next is our multi-asset income portfolios. And they are constructed to provide a sustainable and reliable source of income that grows with economic needs over time. In terms of total returns, multi-asset income portfolios continue to recover by 3.3 to 8% this quarter. Despite lagging the dividend-intensive benchmark that's heavily tilting to financials, our multi-asset income portfolio still outperformed most of our competitors out there in the platform for this quarter. And in Q1, people were concerned about inflation. So in the context of higher inflation expectation, our multi-asset income portfolios are optimized over different asset classes to diversify across different risks, including inflation risk, credit risk, and as such, reduce the overall portfolio risk. And currently, the yields for our portfolios are around 3.3%, which is more than 2% yield on US Ag and more than twice the yield on the broad global equity market. And so that's our index and portfolio performance. Now let's take a look at assets we hold in the portfolio. First, we have fixed income. And overall for Q1, fixed income market struggled. The yield on the 10-year treasury rose to 1.74% from 0.93% in the beginning of the year, and the yield curve steepened further over the quarter. The US core bond market fell 3.4%, and the US Treasury finished its worst quarter since 1980, followed by investment-grade corporate bonds. The decline in US Treasuries has turned one-year return into negative, while US corporate bonds were still up roughly 8% from a year ago. High yield, on the other hand, was the only bond segment that stayed positive. International treasuries and emerging bonds posted negative returns this quarter, in part due to the strengthened US dollar, which was up 4% this quarter. And I would like to add some color to high yield bonds in the context of rising rates environment. We know high yield bonds are affected by rising rates and rising yields, just like other high quality bonds, but usually less so, because they tend to have shorter duration and higher coupons. As we can see from the chart, green bar and blue bar each represents yield to worst and duration. The yellow dot here denotes the yield to worst per unit of duration. And then we can see high yield has the highest per unit of duration among different bond segments. And this chart helps explain some of bonds returns we saw in Q1. Next, our equities. This was another quarter of gains for most equity markets, though the gains were not as dramatic as we had in 2020. With rising hopes on the economic reopening, value and small caps have continued on the strong run since October, whereas growth, which have benefited much from the low rate environment and work from home norms, came under increased pressure. Large cap value was up 11.3%, outperforming the large cap growth by the biggest margin in 20 years. Small cap value with the 21% gain was the top performer as well as the biggest contributor to the performance for this quarter. The dividend stocks also had a good quarter. Meanwhile, stronger prospect of economic growth also boosted stronger performance from the US relative to the international markets. But Europe held up really well in the light of the strengthened US dollars. China, which has been a really beneficial component to the portfolio in 2020, was almost flat this quarter. Hedging assets like gold ended in the negative territory this quarter, bringing its one-year return to the single digits. So in conclusion, we had an overall good quarter to start 2021 with concerns and uncertainties. And with that, I'm going to pass things over to John to talk about market perspectives. Thank you.
Thanks, Joy, for the excellent review of market performance. I'll be discussing some of the key ideas covered in our Q1 quarterly review. This was not an uneventful quarter. As the end of the pandemic came into view in the US and the new administration's stimulus bill became more likely, expectations for growth and inflation increased. This had considerable consequences for markets. As Joy showed, risky assets did well, but defensive assets did not. The S&P returned 6%, while the Ag returned -3%, as shown in the graph. In our view, there were two main themes of the quarter. First, the new administration has brought significant changes to economic policy. Its $1.9 trillion stimulus package reflects a fundamental shift toward a more progressive fiscal policy. Second, by taking a confrontational approach toward China, Biden demonstrated his commitment to making the US economy more competitive globally. The most important theme of Q1 is the fundamental shift in economic policy. The $1.9 trillion stimulus package is expected to boost US economic growth significantly. The stimulus checks inject roughly $400 billion into the economy, and the extended unemployment benefits provide short-term relief. Many economists believe these provisions will be particularly effective because they give money to those most likely to spend it. The economic recovery was already underway, with unemployment falling to 6.0% in March, so the stimulus will amplify the recovery. The Fed predicts US GDP will expand by 6.5% in 2021, and unemployment will stand at only 4.5% in Q4. Although some critics argue the stimulus is too large, that's preferable to being too small. Markets do indicate inflation will be higher for the next few years, with inflation tapering off over time. The stimulus reflects the Biden administration's commitment to actively stimulate growth while reducing inequality by expanding the social safety net. Crucially, this commitment, paired with the Fed's new approach of prioritizing full employment, may represent a policy shift as momentous as the transformations that began in 1980 with President Reagan and Fed Chair Volcker. Policy under Volcker and Reagan focused on fighting inflation by using high interest rates, while boosting growth using tax cuts. In contrast, policy under Powell and Biden focuses on boosting employment with low rates, while using active, progressive stimulus programs to bolster growth and reduce inequality. This is really a monumental shift. Biden endeavors to overhaul and expand the social safety net for a post-pandemic world that's unfriendly to less skilled workers. Stimulus checks, the child tax credit, and several other stimulus provisions are highly progressive, and these provisions may boost growth further. Some recent economic research suggests that economic inequality can actually hamper growth. The open question is whether Biden is able to fully implement his vision, and whether these shifts in economic policy can be sustained for years, like Reagan and Volcker's policies were. The other central theme of the quarter was the Biden administration's new approach to China. Whereas the Trump administration's main goal was to limit China's economic rise, Biden's primary aim is to increase the global competitiveness of the US in certain strategic sectors. Both the US and China are interested in reducing economic ties and securing their supply chains for strategic sectors. The economic and geopolitical confrontation will probably last for years, given the bipartisan consensus regarding China and the US. As vaccines were distributed globally, China underperformed most major equity markets in Q1. Rising US yields, alongside Biden's confrontational stance, helped trigger capital outflows from China. Meanwhile, within China, monetary and fiscal policy has tightened, while it remains loose in most of the world. Beijing also continued its clampdown on private tech companies. Hence, the MSCI China index was flat in Q1, unlike most major equity markets, which did well overall. The upshot is that investors should be cautious when deciding how much to invest in China, carefully weighing the trade-off between these risks and the benefits of participating in China's robust economic growth. Beyond the shifts in China-US relations and in economic policy, other notable themes in Q1 cannot be ignored. The rise in Treasury yields, triggered by the Georgia Senate runoffs, was dramatic. The 10-year yield, which had remained below 1% since last March, closed the quarter at 1.7% as investors priced in higher expectations for growth and inflation. The Fed hasn't directly intervened to stop long-duration yields from rising, but it reaffirmed its commitment not to raise rates soon. Some investors have worried that the rise in yields would trigger a decline in equity prices. All else equal, higher yields make equities less attractive relative to bonds because the discount rate on equities has risen. The markets are really simple, and the S&P rose 6% in Q1, even as Treasury yields nearly doubled. The graph on the right shows the 10-year Treasury yield in white and the S&P in blue over the last year. You can see that 10-year yields have more than tripled since July, yet the S&P has steadily increased. Some investors have also been worried about the decline in bond prices. However, there's no guarantee that yields will continue rising, and in April we've seen yields decline moderately. Bonds, especially treasuries, are used to help maintain the risk control of New Frontier's portfolios. Anyone invested in an optimized ETF portfolio, such as a 60-40 strategy, should not be deeply concerned about the increase in yields this year. Rising US yields also have global implications. Higher yields or higher treasury yields may complicate the recovery in developing countries by making their markets less attractive. Some developing countries recently experienced capital outflows and declines in equities. This, in turn, can pressure developing country central banks to raise rates, which could further slow their recoveries. However, higher treasury yields don't guarantee inflation. Yields and inflation don't always move together. For instance, considerable changes in yields since 2008 were not primarily driven by inflation, and in the early 80s, Volcker raised rates in order to lower inflation. But treasury markets do indicate a modest increase in inflation that will subside after roughly 5 years. The graph on the right shows break-even treasury yields over the last year. These measure the spread between T-bills and TIPS, and this indicates inflation expectations. Moving along the x-axis, you can see how inflation expectations have steadily risen since November following vaccine announcements and the election. The blue curve shows 5-year break-evens, which indicate an expected average inflation rate of 2.6% over the next 5 years. White shows 2-year break-even yields at 2.7%, and red shows 10-year break-evens at 2.4%, indicating that after 5 years, inflation is expected to subside to roughly 2%. It's very comforting that markets indicate that long-term inflation is not expected to be high. Nevertheless, break-even yields have historically been imperfect predictors of inflation and interest rates. And right now, any inflation forecast is particularly debatable due to uncertainty surrounding the shape of the global recovery and the consequences of the $1.9 trillion stimulus, in addition to the $2 trillion infrastructure proposal. Another notable theme of the quarter is global divergence, both in capital markets and the real economy. US GDP is expected to grow at a faster rate in 2021 than all G20 economies except for China and India, according to the OECD. The table on the right shows OECD forecasts for 2021 alongside actual GDP from 2020. It's striking that few countries other than the US, India, and China are expected to exceed their pre-pandemic GDP levels in 2021. Much, but certainly not all, of this divergence can be explained by COVID-19. The European Union has really struggled to distribute vaccines effectively, and European stocks underperformed as infections rose in several EU nations. Meanwhile, the UK and US were relatively successful at distributing vaccines. Additionally, as Brazil became a global epicenter for COVID-19, Brazilian equities returned negative 10% in Q1. But a sobering fact to remember is that 1 million people died globally of the virus this quarter, over a third of the recorded cumulative death toll as of March 31st. I also wanted to mention 2 dramatic investment events from the first quarter. First, retail investor activity had a sizable impact on certain asset prices in Q1, with Bitcoin and GameStop being the most notable examples. The GameStop saga was not a normal short squeeze. GameStop's market price has risen over 700% year to date. GameStop enthusiasts convinced enough people that the company was undervalued by nearly an order of magnitude. Markets are inherently social institutions, where popular beliefs shape expectations and valuations. But information might eventually show these beliefs to be wrong. Another dramatic investment event was the collapse of Archegos Capital in March. The value of New Frontier's investment process can be illustrated by contrasting us with Archegos Capital. Archegos collapsed because it held highly leveraged positions in a small number of individual stocks. A leveraged portfolio can underperform by more than 100%. In contrast, our ETF strategies don't employ leverage, and we deliberately avoid being overly exposed to individual risk factors or asset classes, let alone individual securities. As a result, over New Frontier's 16-year track record, our core global strategies have never underperformed their benchmarks by more than 3.3% in any calendar year. And this is based on returns from our 6 global core indices. And we had underperformed, the year that we underperformed 3.3% was 2009, which is a very unusual year. And we had outperformed in 2008, so it really was just balancing out the overperformance from the previous year. In addition, New Frontier does not make speculative investments. For example, adding Bitcoin to a portfolio would significantly increase this risk. Bitcoin is extremely volatile, and cryptocurrency valuations remain poorly understood. To wrap things up, it's clear that this quarter featured a dramatic reset in capital market expectations, epitomized by the substantial rise in yields. Investors, therefore, should not rely on expectations forged in 2020 to make asset allocation decisions in 2021. The underperformance of China and growth stocks in Q1 illustrates this clearly. Just as important, uncertainty remains elevated, especially in international markets. Thus, being exposed to any single asset class is particularly risky right now. The graph on the right shows the Michaud efficient frontier, which is optimized over many investment scenarios, including scenarios where bonds beat stocks or most asset classes decline simultaneously. To say it another way, we optimize over uncertainty. By creating optimally diversified portfolios that account for so many possibilities, our portfolios are well prepared to navigate these uncertain times. I'll now pass it over to Dr. David Esch, who will present a research update that showcases how New Frontier is involved in supporting cutting-edge investment research.
Okay, thank you, John. Good afternoon, and thank you for hanging in there with us, to those of you who are still here. I don't usually get to do these things, so I just will introduce myself. I'm David Esch. I'm Managing Director of Research at New Frontier, and I'm here to give you a brief research update. So let's see, we're on the wrong slide here. Okay, so first of all, I'd like to direct your attention to the New Frontier Institute, which is the newest part of our company. There are more details to follow in the marketing updates section, which is immediately after me. But this is an important development in New Frontier, because the New Frontier Institute is not only a repository for all of our research articles and various white papers, but it also functions to sponsor and organize various events and speakers through the year. And in particular, this spring, along with the CFA Society Boston, we're sponsoring the Distinguished Lecture Series for the spring of 2021. This series of lectures has 4 lectures total, 3 of which have already passed, but there's still time to register for the 4th one if you're interested in doing that. In particular, I'm going to focus on the 2nd lecture, which was titled, "Do Stocks Outperform Treasury Bills?" And it was given by Professor Hendrik Bessenbinder of Arizona State University on March 17th. This is quite an attention-getting title here, because it seems to contradict everything that we think we know about stock returns versus bond returns. Usually we think of stocks as reliably outperforming bonds, and indeed our estimates for stocks are usually higher in terms of expected returns. So what's going on here? Well, there's an element of truth to what we think we know, because on average, the average stock return is better than a treasury bill. But when you look at a single stock, the average being better is just because a few of them do very, very much better, whereas most of them fail to deliver sizable gains over the long horizon. Well, Professor Bessenbinder's research consisted of tallying up the population distributions over the entire history of the CRISP data set for lifetime returns or terminal wealth distributions of individual stocks. And indeed, the most common outcome for individual stocks was an entire loss of capital. That is a negative 100% return over the history of the listing. Well, that looks like pretty bad news for stock investing. But however, the good news is that most investors don't invest that way. And in particular, New Frontier has various investment policies which assure investors with 100% certainty that ruin is not going to be the outcome of investing in stocks. In particular, diversification, risk control, and rebalancing are policies which can avoid that fate. So, I'm sorry, I need to go back. Sorry about that. So as far as the lecture itself, this updates and continues a long history of research about long-term stock returns. And in particular, Fisher and Laurie in 1970 produced a very important paper that tallied up all of the history of stock returns for individual stocks before 1970. So you can imagine, without modern computers, that was quite a chore to tally up all those results, but they have it in the paper, and it basically says the same story as what we see in Best and Binder's research. The research also is a great complement for our own Dr. Michaud's work. In particular, his 2018 CFA lecture series that's called Finance's Wrong Turn is about what can happen when some of these principles are ignored and they're treated as just, you know, using the arithmetic mean rather than the geometric mean. Is a core principle that is what is being referred to as finance's wrong turn here. But it's also related to his work on the geometric mean, which is a mathematical transformation of the terminal wealth distribution. So it's essentially talking about exactly the same thing. And so there are several papers that are on the New Frontier Institute website that are about the geometric mean, as well as several articles on our blog which talk about that if you're interested. So just to conclude, the lessons that we learned from this research that was presented in March are that it's very important to maintain a diversified portfolio of stocks and to control your risk and rebalance when it's necessary. And New Frontier has elaborate policies in place to deal with all of these things to protect investors from those outcomes. And lastly, I'd like to encourage everybody to register for May's lecture in this series, which is about an entirely different topic. It's titled, Who Owns and Trades Bitcoin? Evidence from the Blockchain. And this will be given by Dr. Antoinette Shore from the MIT Sloan School of Management. And all of the lectures have been outstanding from this series, so I'm sure the last one won't disappoint. And with that, I am going to hand the floor back over to marketing. I guess Pauline will give a marketing update. So thank you very much.
Thanks, David. It's always exciting when we get to hear from you on these calls. So I will give a very brief marketing update. As a reminder, after this section, we have a little bit of time for Q&A. So if you'd like to submit any questions, please do so using the chat feature of GoToWebinar, as your lines are still muted. So to start off, I just wanted to give you a quick reminder of the team available to support you. Many of you are probably familiar with our directors of wealth management consulting. So that's David Schubach in the East and Jesse Andrews in the West. and they remain available to you in the field, albeit still largely virtual at this point. Nick Lamb is our Vice President of Business Development, and he is also available to you via phone or email to answer any questions you have or to share any resources you may need. And we're very pleased to announce the addition of Kieran Popzak as our National Business Consultant. And much like Nick, Kieran is available via phone or email to support you with any questions or resource needs, so please do feel free to reach out to him. Next, I would like to highlight Frontier Advisor, which is our one-stop advisor resource center where you can access performance analytics, downloadable materials, and trade announcements at your convenience. And we invite you to visit frontieradvisor.com to create an account and access these tools. You may have also heard that we have a client-friendly materials section available to you on the portal under the Resources tab. This includes pieces on philosophy and strategy, as well as fact sheets, notes from our investment committee, and third-party articles, all of which you can use to support your clients. And many of you are already taking advantage of this new section, but for those of you who are not, we definitely wanted to encourage you, again, to check it out. And then David mentioned we have a lot of programming kind of coming through the pipeline through New Frontier Institute. And to that end, we were going to be hosting some additional educational programming throughout the rest of 2021 and would love to get your thoughts on kind of which topics interest you most. So with that, if you could just take a quick few seconds and let us know which of these topics kind of piques your interest. We'll just give everyone, 5 or 10 seconds. Looks like some of the answers are already coming through, so thank you. All right, we'll give it a couple more seconds here. All right. And with that, we will close it out and check out some of the responses here. So it looks like there's a bit of a preference for the active-passive debate. So we will definitely keep that in mind as we continue developing our 2021 programming. So thank you all so much for your input. All right. Next, we will just remind you, David did a good job kind of highlighting our New Frontier Institute, but we're very excited to announce the launch of this institute, which is designed as a scholarly repository and resource for academics, investment professionals, and investors with interest in understanding the evolution of quantitative asset management. New Frontier Institute aims to bridge the gap between the academy and the workbench by using cutting-edge research in daily practice. And as David highlighted, New Frontier Institute has collaborated with CFA Society Boston, and we are in the midst of our first Distinguished Lecture Series, which allows you complimentary access to expert insight on important investing issues from ESG to Bitcoin. And we hope to see you on our next Distinguished Lecture presentation with Professor Antoinette Shore from MIT. That's going to be on May 13th, and that'll be focused, again, on Bitcoin and blockchain investing. For more information on this and all New Frontier Institute events, please visit the events page on nfinstitute.org. We mentioned a few times earlier in the presentation, but we have a full set of indices which describe the performance of New Frontier's multi-patented investment strategy and index form. We have our benchmark series. You can see the tickers listed here, as well as our global and US core series. For information on all of our indices, please visit the indices page of our website. And handily, you can also add them to any smart device using a Stocks app, so you can access them in real time and on the go. All right, so with that, we still have a couple minutes for Q&A, but it looks like, let's see. Oh, actually, we are right at time. So with that, we can wrap things up. If we didn't get to your question, we will definitely follow up with you one-on-one. But I want to thank our presenters as well as the audience for joining us today. And we look forward to seeing you on New Frontier's next webinar.